Hello and welcome to Leviathan News. Today is September 11th, and we have on Colin Platt here to talk about Liquity. He has just joined the Liquity team.
I
So,
have.
yeah, and is going to be leading leading on the product side. Is that right? The V2 deployment?
Yeah. I think my title is head of product. Obviously, titles is something I care a lot about for the V2 product that we're launching next year.
So maybe you could go into a little bit of your background, because I know that you've not been roped into, you've been in DeFi and doing DeFi stuff for a long, long time, but this is the first time that you've kind of gone full time and probably getting, paid out by a DAO or something like that. So maybe you could walk us through what's been happening for the past few years.
Yeah. So I kind of got my start in my career working in banking. I worked for a large French bank called BNP Paribas. I was based in London, spent some time in Paris and New York as well. I started out doing structured products, so all kinds of weird financial derivatives with a variety of different clients, looking at different ways to turn derivatives into investment vehicles of different sorts. I eventually heard about this thing called Bitcoin back in 2013. I think the price had just hit $1,000, and I saw it on the local news or something, and started getting really interested in that. And by 2014, I was leading a small group doing research for the investment bank into everything that was cryptocurrency and blockchain. My kind of initial job was, what is this Bitcoin thing? Can we make money out of it? Kind of contrary to what a lot of people thought about banks now and back then, there wasn't necessarily this initial hatred, at least outside of the US. I know that in the US there were kind of differing views on Bitcoin at the time. Ethereum came out. A lot of that was done out of Europe. There was a very big team in London looking at that, so got to bring them in to meet senior people at the bank, and that was all quite cool. Then mainnet launched, and I realized that banks were not going to do anything quick. So decided to go out and do my own thing. Spent some time building projects. Did something for London Stock Exchange around what we would now refer to as DeFi on an institutional front, looking at clearing, as well as a number of other smaller projects here, there, and everywhere. Kind of focused on one end, how do we create financial products backed with cryptocurrencies, to how do we do this blockchain thing or anything like that. Eventually scared enough clearinghouses and stock exchanges that we didn't get any funding in 2017. Ran out of that and decided to go focus on this new emerging asset class that was cryptocurrencies. So got very lucky in a wave where lots of people were raising lots of money to do different things. Found out about NFTs, did some work with those back in 2017. Got really big into this trend with MakerDAO and everything that was going on there. And started using Uniswap V1 back in the day. Really big into DeFi, did lots of work, everything from advising companies to kind of writing some articles. I did some stuff for Decrypt, rode that around, learned how to code Solidity in the meantime, and eventually started doing fun things and said, hey, let's kind of wrap this all back around. Now that we're looking and focusing on building here in 2023, met up with the guys at Liquity, heard about what they were thinking about doing for V2, and said, hey, that's something I need to be a part of.
So you've gotten the full gamut now, from the TradFi space to oh, hey, let's deploy fully immutable contracts that are unregulatable.
Unregulated. I like that.
And that's what you want to be, right?
Yeah. And I think it's even, regulations is an interesting thing because it's, I think decentralization and immutability, part of that is unregulatable, as part of that is, being solid bedrocks and being reliable and dependent. So I think that there's some really interesting ideas in that design space that really need to be explored further. Moving away from things like DAOs, which I think are interesting, but governance DAOs are kind of fraught with their own issues as well.
Yeah.
So curious to know, you've been on both sides. You said you're building complex derivatives products for banks, and then you've been in DeFi. Which is more degenerate, the TradFi derivatives or the DeFi stuff you're seeing?
No question in my mind. Cryptocurrency traders are way more degenerate than any banker I've ever met in my life. There'll definitely be things, and when I first got my start, we were still coming off the high of the pre-financial crisis. I was in Europe at a more conservative bank, but lots of the traders that I met with, that I did studies with, that went to UK and American banks in London, had some definitely really wild stories. But I still think, you go to any major conference with crypto people and go see what's going on there, bankers can't hold a candle to that.
So where are we now? And maybe you can give us some European flavoring, because after the past 2 weeks of IRS guidance and CTFC enforcement, as well as this recent IOSC paper, the outlook for DeFi and crypto inside of America looks pretty grim. How is it looking on the other side of the pond in Europe?
Yeah, so I think from a regulatory front, I mean, I don't want to say that everything's rosy and great, because that's definitely not the case at all. But it's not as dire as it seems. There are a lot of good things that have come out on the regulatory front, which are trying to move whatever it is, crypto, DeFi, broadly speaking, as well as NFTs to a degree, into some kind of purview. And of course, Europeans are, very avant-garde on regulation. I'm in France, so they really love rules here. They're very good at making up rules, which obviously brings a lot of administrative headaches. But at the same time, I mean, there's a reason that a lot of legal structures are still set up out here, even, moving and looking at other asset classes. There's a reason that places like Malta, places like Luxembourg, places like Switzerland have historically been very good for moving the needle in finance. And I think we're seeing the same thing happen in crypto. And lots of the stuff drives me crazy to have to deal with. But at the same time, you kind of go, look, given the alternative of what's happening in the US, I'd like to at least know what we're playing with. And yes, you need to hire lawyers to fill out paperwork. But at the end of the day, you know that there's a path forward. You may or may not want to follow that path, but at least it's fairly clear.
Yeah. When I was going to the I forget what the Zug meetup was, the Crypto Valley meetups that they were having, they were talking about how, like, the regulators in Switzerland were you could call them up, like if you had a Swiss company and you wanted to try something new, they were open to trying things, because it's very boutique, it's small, it's a smaller country, and so they have the ability to work with these companies to try out different things. And sure, like, if you look at what Swiss crypto exchanges have to go through to comply with the law, I mean, it is quite strict, but at least they have clear regulations now about what to do, versus the United States, where there's a hodgepodge of different regulators that provide zero guidance, don't talk to you, and essentially will just like slap enforcement actions on you post fact, and say, thank you very much, sir, pay $20,000 or $200,000, millions of dollars even.
Yeah, I mean, the US are famous as well for deciding what you did at some point in past history is now illegal, and thus was illegal at the time. And we've seen that kind of across the gamut, a lot of things. So yeah, like Liquity AG, the company I'm working for, is a Swiss registered based company. Obviously, speaking with the regulators there, that's a very high priority for them. And from my own dealings with them pre-Liquidity have been very positive. As you say, there are administrative steps. It's part of dealing with any kind of bureaucracy. But they are, when they say they're interested in learning and listening, I've found that generally to be true of the Swiss regulators as well as other regulators in Europe.
So let's hop on to Liquity. Like we spoke to we spoke to them when they announced their V2. They actually like buzzed in on the smartphone to come talk with us, and we got a little bit of information about what was happening. That they're building this like product that's going to have like a leverage side and a non-leverage side to it, and it's going to incorporate LSDs. And there wasn't a bunch more that came out of that. So over the past few months, and especially since you've come on, like, what are you planning to see through with Liquity, and what's kind of the general vision that you're going to help execute there?
Absolutely. So there's still a few things that are up in the air. So there'll be things that'll kind of be a little bit fluffy on here, and it's not trying to hide anything. It's just things that are in discussion with the team. So I started at Liquidity a week ago today, and started looking at V2, what they proposed, what they're putting together, and other ways that we can kind of work with it. So high level, first and foremost, what we're looking at doing is building a better stablecoin. And we say a better stablecoin, we mean kind of following this diagram that we call the stablecoin dilemma. And very much like other things in cryptocurrency, we have this trilemma, sorry, not dilemma, where we focus on decentralization, scalability, and stability. So what we mean really, really clearly there is we're not looking to add USDC or USDT on the back end to kind of prop up price when it needs to be done. Is looking to scale, so it doesn't need to necessarily be reliant on pure borrowing demand, which is what we've seen in other stable coins, including our V1 implementation with LUSD. We can scale the coin based off of how many people want to actually borrow against assets. And we're looking at the stability, really, how do we hold close to peg while maintaining these other things? It's a very interesting, complex design space, and we've come up with something quite interesting, which uses a lot of kind of options theory. And so one of the founders, who's a deep financial and economic researcher, has come up with a really interesting model, which we'll communicate more about. So trilemma, sorry, I saw the comment.
Trilemma, yeah.
You can go try something called llama, so really the idea of balancing these three things in a way that is usable. So let me talk a little bit more about why that's important to us and why we want to solve that particular space. I talked about regulations. We talked about immutability. One of the really difficult things for any DeFi protocol is to be able to kind of take their hands off and let the thing work the way it was planned to work and not guide it. And this is something we've seen with a number of other stable coins, ranging from, let's say, the more conservative ones, and one I think we'll get into a bit more later, Maker and Dai. Very interesting experiments, what first got me into DeFi. On the other ends, we've seen things that have not worked and needed a lot of kind of propping up. Algorithmic stable coins come to mind. What we really wanted to do is be able to offer the benefits of decentralization, so we didn't have to rely on real world financial assets. RWAs and all that great stuff is interesting. Personally, it's not my focus area. I understand why people want to do it, but what we're trying to look at is how do we use these decentralized financial assets that we have and create something that offers us the second point, scalability. How can we offer these not just in a very, very small, narrow bandwidth based off of borrowing? How can we offer this in something that can move to the size that it needs to move to and scale down? So ideally, if this thing is successful, it can become a multi-billion-dollar asset. The stability part, how do we make sure this thing is always worth about $1 or whatever other index and benchmark somebody would want to set up? So when I'm talking about dollars, the decentralized stablecoin, obviously people are focusing these on to other currencies or other types of assets as benchmarks. This is really important because you do have a lot of people, and we're sitting here in 2023 in the middle of a bear market where they want to keep things, even with inflation and those forces, in something that somewhat matches a dollar, because at least you know what the dollar is going to be tomorrow. With all this kind of comes, where can we expand and where can we move this? As we're seeing more and more interest inside of DeFi, as well as other products bringing in, quote unquote, the normies, they're going to also care about things like a dollar. And how do we keep everything from moving into money sitting in a bank account that, whether it's Circle and Coinbase or whether it's Tether, are earning interest on, while we're sitting here essentially funding that to try to make money doing anything else. So we think it's a really interesting space. And it's, as I said, was really interesting for me, obviously, coming to focus on this. But that's what we'd ultimately like to solve with this V2 stablecoin. The how we get there, we'll talk a little bit more about. But really what we're focused on is also linking up with kind of what are some of the other ways to move that risk, and people that are seeking risk to hand the risk related to the back end of a cryptocurrency onto those interested speculators and parties.
Yeah, I think one of the strongest things that you can say about Liquity is that the contract's pretty much deployed, immutable, cannot be. The V1 is essentially out there, never can be upgraded or changed or anything, and that's looking more and more as a huge beneficial aspect coming into mid 2023, where the idea of responsible parties, whether they be DAOs or the development team or other parts of the chain of creators or even users of the product, could be held liable for these contracts that go out. And when you're deploying these immutable contracts, it's essentially out into the wild, and that's it. And then you can focus on integrations and other parts. Like, how do you balance that with, or how are you thinking about balancing that for Liquity V2, where the design definitely has I mean, it's different, right? So you're going to be using different aspects. You mentioned options that'll be working with it, and I think that'll be through like Uniswap v3 and how that functions in building these range orders to be able to create quasi options.
So it's even I guess a little bit tweaked from that. So we're using kind of options theory rather than necessary pure options or Uniswap v3. We're trying to build this thing in a way that is standalone and composable, because obviously love Uniswap, got very interested in DeFi because of Maker and Uniswap on the other side. But what we've seen with Uniswap, which becomes a problem when you have an immutable protocol, is they do upgrade over time, and liquidity moves with that. So obviously, we've been talking a little bit about Uniswap v4 in the market. I think it's very interesting things to see. Uniswap at X, and they'll continue to have other upgrades, which I think is great to see that innovation. Of course, Uniswap v1 and v2 are still out in the wild. v2 is still very widely used. So what we're looking at is also offering this ability to kind of bring in the way that an option works embedded straight into its own protocol. And that means being able to do some of the swapping features directly inside of it, which gives us much greater flexibility on setting pricing that works with a decentralized stablecoin, building a bonding curve around that. And I think the other thing that you kind of hit on, which is a really interesting thing that I really appreciated when I started talking to the guys at Liquity, their approach goes beyond just the contracts. They have an entire plan around their front ends where they don't host their own front ends. They're done by other parties that are interested, and there are economic incentives built around this. Tying that back around to your previous question, it's really about creating a market that people are properly incentivized to ensure that things stay in balance. Now, that's a very complicated thing, which is why we're not, just throwing this thing out the door next week. Also, the market is probably not ready for that, but that's another story. We can't control that. Hopefully, when we're ready, it will also be ready. But we're spending a lot of time kind of researching, saying what happens if we tweak this parameter and this parameter, doing some modeling. We should have some news in the next couple of weeks about some parties we're working on that front. But there's lots of really fascinating heavy-duty research with hardcore economists from the crypto area, as well as more traditional financial and economic backgrounds, and looking at how we model this into a very strong, robust way to build these things. So I'm very excited to see some of the research that's coming out internally as we're doing that, and to be able to talk more about that publicly, which hopefully we should be able to do in the next weeks and months. But it is really a fascinating process to do that is quite complex. And that's, as I said, why we need some kind of time to refine this. But I am very excited to see it kind of got into the wild.
Yeah, I'd be interested to know about how you guys are thinking about integrating and adding different LSDs as collateral. These LSDs, that we're still in the early days, and they're still kind of the flavor of the month, where first there was Steth, and then RETH, and now you have FraxETH, and now you have like 100 different other types of LSDs that are popping out. Soon we're going to have restaking of LSDs where you could put it into eigenlayer and have extra yield on top of that. So like, how do you take into account like all these different variations of like staked ETH collateral and balance those risk parameters when building these contracts that are going to spit out like dollar denominated debt?
Yeah. So with staked ETH, I guess in short, we don't know what the perfect answer is quite yet. We don't know if there'll be the perfect answer by the time we launch, but we'd like to find the best answer at the time that we launch. And there's a lot of different avenues that we're looking at. And I think the market is starting to solidify around a few LSTs, whether they're perfect or not. We don't know yet. There are lots of concerns around centralization on different things, some of which are valid, some of which are massively overblown. So what I will say on that is I think that we're going to see more and more development, more and more understanding of the underlying risks that come with LSTs, in the next few months.
It's okay. We're pro LSD here.
Pro LSD. But I think they can really only get better. They're still very young. We've seen this outside of Ethereum itself. A number of kind of L1s, alt L1s are looking at that had staking in it, and realizing some of the pluses and minuses of them. So I think it's really interesting research, and I'm from all the discussions I've been having, people understand a lot more than necessarily they comment out in social media on about what are some of the things they need to be concerned with. And I think we'll only see improvement. If I can talk about, Lido, however you pronounce it, some of the really interesting things is they can actually fix and amend some of the problems. Now, that's not perfect because it adds discretionary aspects that are not necessarily immutable, which aren't always perfect. But they do offer some more space. Some of the other protocols as well can either reissue and implement and have new things. So this will be something that we bring in to offer hopefully the best risk profile that matches with the rest of the product.
Yeah, that's interesting you talk about risk, because one of the biggest differences between Liquity V1 and V2 is that the risk parameters are going to be shifting out of the application layer and into the consensus layer. And so now you have two different, at least in the application layer, everything could be internalized to the code base, right?
Mm-hmm.
But now we have an external consensus layer where how Lido or Frax or how Rocket Pool, they all have different structures in potentially different risk parameters that have data that needs to be oracleized off of the beacon chain, consensus chain, and then transferred to the application chain for usage.
Mm-hmm.
So have you guys started looking at these Oracle issues, how to get data provision from these sources, and what are you guys looking at?
So that's something that we've done a lot of research on. The team actually published a blog post not too long ago under Liquidity, talking about some of the different pluses and minuses of different Oracle solutions, broad sweep, not just on that particular type of Oracle, but Oracles in general, and have received a lot of feedback positively and negatively about it. But I think it does paint a pretty interesting picture about what is the space out there. So that is something this team, one of the interesting things is they like to measure twice and cut once. So they do look very heavily at these types of things. And there are people that are much more qualified than myself on Oracles. That's been something that's relatively new to me in my career, working with this team and their understanding on those. I did the on-chain NFT stuff, so and things with AMM, so we didn't have to worry about that before. But what I really do feel comforted by is when the team makes a decision, they have done a lot of research and motivated on that. Mm-hmm. I think the other thing that kind of comes in when you bring up Oracles is it's not only about how well an Oracle functions and some of the risks and highlighting those inside of it. It's also about integration. Different Oracles, regardless of how good they are, we kind of come down to Betamax VHS discussion, because who wants to use which Oracle? Who relies on the Oracle outside of us? And who will accept an Oracle is a very important part of Oracles as well.
Yeah. I mean, there's a ton of different Oracle providers outside of Chainlink, but for brand recognition and just the ability to say oh, hey, Chainlink's probably not going to fail and cause us issues, which matters a lot when you have tens of millions of dollars or hundreds of millions of dollars in a DeFi product. You just stick with what works.
And we've seen a number of cases in the past where Chainlink Oracles have done quite a bit to kind of help and save things. I mean, I think Curve was a great example. When it was struggling, part of kind of what ultimately stopped the bleeding was having Chainlink Oracles as part of that calculation.
Yeah.
Check the prices, still struggling, sir.
I'll deal with struggling, but at least not bleeding out and dying.
I did have a question. So at Stable Summit, Lauco described some of the expectation that the Liquity V2 design would be delta neutral. Are you in a position to elaborate a bit more on that?
Yeah. So first and foremost, kind of having the background of a stable coin, we need to be able to move risk and warehouse it elsewhere. So the idea is kind of, if you look at Ether, 1 unit of Ether, and you say, hey, there's some amount of it where we can be pretty sure that the price is always going to be liquidatable above this. We can kind of extract that and compartmentalize it if we move this risky bit to somebody else that's willing to back up that risk with other things. So when we talk about kind of delta neutrality in that, the idea is twofold. First is this thing should be fully backed at all times with liquidatable, recuperable dollar values. But also, we should be able to offer something that isn't fully built on credit or isn't built on at all credit, which is some of the problems we've seen with algo stablecoins and some of the other RWA backed ideas.
Interesting. Now, we were talking online before the show about essentially when I reached out to you was when Rune had announced that Maker's looking into like a Solana fork to handle their off-chain governance, which is, I'm still not big brain enough to understand the end game. Like I've read the end game posts, but there's I think something about it which is on a different level. So like for a Garrett. So for
Just having some fun in the chat.
Yeah. So when you look at a project like Liquity, which is like fully on chain, immutable, very governance minimized, versus Maker, which is essentially trying to be like a quasi bank and have this off-chain governance, like separating the governance layer from the application layer for specific reasons. I don't understand why they would need to have millions of transactions a set or tens of thousands of transactions a second on a Solana fork. Like, like what do you have any thoughts on like what's the kind of differences here in outlook?
Yeah. So I think, there's a number of things they're trying to accomplish ultimately, right? Having lots of governance and governance that over time has proven that it is willing and open to having, let's call it, less decentralized aspects in the protocol. You ask a lot of questions about where Maker is and why it's on mainnet and why that's where kind of, when we talk about stable coins, I like to think about where the motor of these stable coins is versus where the assets are. So obviously you need to have the assets, whether they're DAI or any other stable coin or LUSD or other things, where people want to use them. Now that could be in mainnet, that could be in an L2, that could be in another L1. We've seen great example has been USDT and USDC. Obviously, their motor is a bank account, but they're willing to issue these tokens that represent ownership of that bank account, in part, indirectly, in a number of different things, from EOS on one end, through mainnet, through Bitcoin, Mastercoin, out in another one. That's where people want to use it. So if that's inside of a Solana fork, if that's inside of Solana itself, I have a hard time, criticizing that. Now, the motor itself and where assets that kind of power this thing are does seem like a strange choice in how they've looked at it, at least on the face of it. But it does speak to kind of how they want to govern and how they want to manage it. Solana app forks seems like an interesting choice, because my understanding of Solana is that it is extremely cheap and scalable itself. So I don't necessarily know why they would want to have something that's an L2 of it, but I could be missing something very key in that. At least if we're to believe the claims from Solana developers and team, it seems like that could live in mainnet Solana. Maybe there are some regulatory concerns they're worried about, which does worry me somewhat, because that could mean things like needing to have KYC and being able to blacklist coins, which I don't think would be favorable in any way, shape, or form for having these. That is something we need to. I'm seeing some of these great quotes here about treadmills. We do need to have a discussion around, what happens if a team does have these controls over it, and what could they be forced to put in? What does that mean? From Liquidity's point of view, we are heavily built into the ecosystem of Ethereum, and that's something that we believe very strongly in. Not going to say anything bad about Solana. I think I have
I think it's great, and I think it's just interesting to see the two dynamics at play, where if you go back to 2018, 2019 with 2020 with single-sided Psi at the time, then DAI, and how it was just like a very simple contract. You put in ETH and you take out DAI, and sure, there was more volatility in the asset itself, but it was very clean. And there was only one asset that could go in, and then they started adding more, and then they started focusing on peg stability, that it meant that they needed to allow USDC into the system, and then USDC became such a huge part of it that, okay, well, now in a low interest rate environment, it's fine that we don't have to take USDC off chain, but now that rates are 5%, we have to find RWA partners that can bridge this USDC off to earn yield that we can push back towards the treasury so that we can stay competitive. It's a totally different shift versus what Liquity is doing, which is staying completely on chain, still sticking with just, at least in the V1 contracts, just having ETH in a fully immutable contract, and maybe making some small trade-offs for V2 to allow LSDs, because you're allowing more risk in based on the actual LSD providers and the risk parameters that they have. But there still seems to be like a how do I describe it? It's a purity of Ethereum, like fully on the application layer, and now like with Liquity V2 also taking in the consensus layer as well too, like trying to make the least steps or the least trade-offs possible to be able to issue this dollar-denominated debt on chain.
Absolutely, and I think you nailed it right there. Is when different trade-offs were made with the design space that V2 was built with. Part of that answer was bringing in centralization. So now that we've kind of seen that and learned from it, and we don't have the tech debt behind that with having V2, we're hoping to be able to offer that more natively.
Yeah. So I got 2 more questions, and we'll move on to the other news. So Billy Welch had a question about how did decentralized stablecoins solve the velocity of money problem and usability in the real economy?
Yeah, so those are really good questions. So I think first and foremost, I want to kind of hit with this model that not every stablecoin is meant for the same use case. So just like every other cryptocurrency, we have a range from money that should be designed to be spent in the real economy versus money that's not necessarily the case. No, that was not a Freudian slip to answer the question. It's money that is made to be used in other different ways inside of protocols. LUSD has been focused primarily on being able to be usable within things like DeFi. But really what we're looking at are some use cases where we need to have strong and stable money that can be managed by other code, that can be managed by protocol itself. So things like DAO treasuries have been a big focus for LUSD. Things like DeFi and decentralized derivatives are another very big focus area for us. And those are things that we'd like to see and expand with V2, learning the lessons we learned in LUSD and V1. So I think those will be areas that we'll see grow, and we'll see, given what you mentioned earlier about having different rules, being able to offer that, have that stability, and be sure that there's not necessarily a government entity that could pull the backing out of a specific address or blacklist something, would be things that we'd want to avoid. So having an asset that answers those is first and foremost on our list. Now, there are a lot of decentralized monies that isn't their focus, or it can't be their focus, but they are trying to focus on how do you spend this to go buy coffee or to go buy a car. And that's not to say that people won't do that with V2, but that's not necessarily the first and foremost of what we're trying to seek out.
Mm-hmm.
As far as velocity of money, I think that's very closely linked with that. Do we want to be necessarily all focused on how do we make money move quicker in the real world? I'm in Europe. We have a very different banking system where money does move generally quicker than it does in the United States. Works different in different countries, but that's not necessarily a universal problem, I would say. So having stablecoins and being able to pay each other around the world is great, and that's something that I take advantage of a lot myself. And I think that will always be there just by nature of having blockchains that can confirm these transactions in a matter of seconds rather than hours, days, weeks, whatever it is, depending on your jurisdiction.
So Billy had a follow-up question about, is it just collateral then, and how can LUSD be in interest bearing to make it more attractive as collateral?
Yeah,
well, I think that's where V2 comes in, right?
That's where V2 comes in. So don't necessarily need to be a PhD to understand that part of LSTs is bringing in and having some form of yield. And the idea is, where does that yield go? How is it used? And that's part of kind of the understanding and the building of what we're trying to do. There should be some yield in there, just like there is in LUSD. It may, however, not be in LUSD as attractive as some people would like to have.
Well, maybe there's a it's not a trilemma. Maybe it's a quadrant where yield is the fourth quadrant, right?
It's another dimension even.
Oh, it's a pyramid. It's like a three-dimensional pyramid now, right?
Good point.
Oh, good. Put a pyramid scheme on the pitch deck.
Here we go.
Yeah, I think Kevin Joy already made a joke about this with Madoff. Yeah, no, it's definitely, it's not only about just pure yield and percentage. A lot of people focus on, what am I getting in yields? And that's been very, very well understood since I guess the end of DeFi summer. It's great to get paid 100 million% in random made up shitcoin. But if by the time you go to cash that out, you don't get any liquidity and that 100 million% becomes zero, that's not particularly interesting. If the underlying motor that's paying your yield is actually Ether or staked Ether, that's something that I think most people are quite interested in having, even if that gets swapped back into something that's a stable form of value. But what people are really interested in is making sure that when it's X%, you can actually get liquidatable X%.
Mm-hmm. And I guess the last question that I have is just about like, what does it say about like stablecoins on Ethereum when it looks like the majority of stablecoin usage is actually on Tron? You look at where developing world, Africa, Latin America, other places are actually using stablecoins in mass, and it's through Justin Sun's USDT.
Look, I wrote a paper about this ages ago when everybody was laughing at Tron back when Udi was at some conference with Justin Sun, and he got really drunk and was saying, buy my shitcoin. I think you can feel however you feel about Justin Sun and about what Tron is or isn't. I think if we hold Tron to the same standard that we hold every other EVM chain, be it an L2 or an L1 out there to the same standard today, I don't think it's horrible. Now, is it the perfect user experience coming from a more pure EVM? I'd say that there's probably some left to be desired. However, it has consistently been cheap. We've not seen a lot of the issues that we've seen in some of the other blockchains, having things like blocks rolled back and forks happening in some of the more widely used alt L1s has not been great, as well as some of the ones that I won't get into, whether they're L1s or L2s, but some of these other chains have seen a lot of issues as well. Tron's not had too many of those, so I can't necessarily say it's all a scam and it's horrible. Did they take ideas and inspiration from other teams? Yes. Yeah. Does that make them evil? I would argue probably not. To the question, the point about, is that being more widely used? I know whenever I deal with East Asia and people ask to get paid, first and foremost, they would prefer to have it in Tron, especially in lower values. And I've made lots of payments in Tether and USDC, more in Tether because that tends to be a more popular currency in East and Southeast Asia in my experience. But if you're paying an artist the $20 or $50, that's the fastest way they can get it. They can cash it out. They have local networks to deal with that. Who am I really to judge that? In the same way that if somebody asked me to pay on one app versus another, if I want their service, I'll pay for it. So again, kind of coming back to the question we had earlier, it's not the same type of stablecoin for every use. Would I back a multi-billion-dollar decentralized derivatives platform with Tron USD or another Tron stablecoin? Probably not. Yeah.
Who's to say? I mean, like, I think one of the things that we do engage in a lot in crypto, and especially, I mean, we do this everywhere, right? Is this like stormtrooper syndrome, where you just say, oh, like, look at the ineptitude and inability of these stormtroopers and bad guys. They're just bad guys to be able to do anything, and yet the majority of transaction volume for USDT takes place on USDT, far outstripping anything on Ethereum for like day-to-day usage. And so framing everything in terms of like, oh, we're the good guys, they're the bad guys, is quite tribal and doesn't actually like lead towards anything, and actually creates blind spots when we should be like building and developing and trying to escape the clutches of the oncoming surveillance state that is going to kill DeFi and crypto usage globally. And if we don't really like focus on that at the core, we're going to be infighting until we all get KYC through our MetaMask wallet and we have to go through an approved RPC to make transactions to buy and sell JP Morgan coin for USDC, and that's it.
To be allowed to buy some groceries, you know.
Exactly. So I want to bring up this Reddit article that I have been found over the weekend. After we discussed all the actions last week, there is a really great lawyer on Twitter called Grant Rainier, or Rainier Grant, one of the two, who wrote this great, like, I don't want to call it grim, but it's a really nice article just talking about how Chainalysis geolocation metadata mosaics will probably be used to block U.S. citizens from DeFi. Now, it's not the greatest headline, but essentially says that the enforcement actions that just came now are just the beginning. If you look at what the CTFC has done, so Open, despite IP blocking the USA and blocking the use of VPNs, was still charged by the CTFC for not going far enough. So what does it mean to go far enough? And he says that in conjunction with the 279-page Treasury proposal, the only way to do this is to apply massive clear and block lists on virtually all front ends by the Americans, and then using companies like Chainalysis to create associative lists or lists of associations where not only sanctioned addresses are here, but American, US addresses, Iranian addresses, pretty much anybody that is on a block list or an allow list, depending on where they live. And so while Vitalik's out here putting out proof of innocence papers with Amin, it really doesn't matter, right? Because right now we have a massive surveillance network that's being built by the feds, where they know every single transaction that's going in and out of addresses. They're pushing for regulatory moats so that they control themselves. And they're building this geolocation metadata mosaic of ETH, Solana, every single network out there. And they're going to use it to dox all of the people in all centralized exchanges, and then use machine learning to tie addresses to blacklists and whitelists, then enforce them with federal prosecution and extradition if devs don't comply. And he goes on to say that there are virtually no limitations, restrictions, or regulations against these Chainalysis companies. They have essentially like free use of all this metadata, junk forensics. He calls it the Patriot Act on chain. He says they can, and they will be doing much more machine learning and basic forensics to build these association lists to give large VC protocols. And then he goes on to talk about like what the effects of this are going to be. He says that it's going to cause globally litigating all developer teams into using middleware to block VPNs as like default criminalization of VPN use for DeFi, globally litigating clear list and block list for associative lists. To even get whitelisted for a front end, you'll have to KYC, and it will be a de facto ban for Americans because no protocol will ever be approved, and not has been so far. If your developer team or legal counsel resists the subpoena by the Americans, the DOJ will go after your banking relations in those countries. You might even get extradited if you're not American. So TradFi clearly uses whitelist blocking of smart contracts to suppress and merge an acquisition and steal the industry, while kicking the ladder out from everyone and building crony regulatory moats based on licensing and registration. And the SEC and CTFC have put out an extensive list of responsible persons. Spoiler alert, it includes virtually anyone involved in the protocol or project from stem to stern. They intend to dox, namely so they can hold them liable for collecting 1099B in the new Treasury IRS proposal. They want the full stack of developer teams hyperdoxed. And then he goes in and he posts the this recommendation from the latest IOSC thing that is quite long here, and essentially ends saying that people will live in denial of the law, how it will be applied to them until the lawsuits get sent to their general counsel. No one in the industry wants to read the language TradFi organizations are writing, what law enforcement is writing, and they don't want to look at the dinosaur comment. Basically, don't look up. And he says he might seem schizophrenic, but he's not. And they have intent, and they're going to use it. And United States citizens may as well become felons for even writing their own code to their own private front end to use a smart contract at the rate these things are going. But if you read all the legal language used by the SEC, the Treasury, the CFTC, they're going to dox the entire protocol team, the entire protocol, the entire company, and so too is Europe and Japan. They want on-chain KYC. We're all in denial, and they want this off-chain front-end middleware permissioning via whitelists, and we're all in denial. So it's coming. Scary stuff.
Indeed, yet I do think that they're not going to be that coordinated that quickly, and so many builders will keep finding like new ways to do stuff, even more anonymously than they do now, probably, because this is going to be like a battle, an ongoing battle that none of the sides is probably going to forfeit in advance. You know what I mean?
Yeah.
And I think that a lot of what, like we discussed like a few moments before, this kind of shows you the fact that, all of a sudden a lot of money is actually going on Tron, because no one knows what's even going on there, but people don't really care that much. What people actually want is to be able to do all kinds of financial like transactions, and they want to do it in the cheapest form possible. And once they get, like a specific obstacle on one way, they quickly move to another one. But this definitely seems like some grim stuff, the way he presents that. And like I said on Friday, I really hope and think that the US will not really go that direction. But maybe
they already have. I mean, look at what the Matcha outcome, right? Look at what they did with Matcha. Matcha was an aggregator that, by chance or just through its existing, allowed people to trade the index coup FLI 2x leveraged ETH token, which the CTFC considers a leveraged commodity. And so it proceeded to go out and bring an enforcement action against Matcha for a product that they did not create, that was managed by a third-party development team, that people were able to access on an exchange that they didn't run. And the only thing that they did was provide aggregation services so that people could make the best trade. And they were enforced for that.
Yet after one time, two times, three times, after a while, won't the Matcha developers decide that, okay, we don't care, we're going to another country to start this whole thing?
It doesn't matter.
Right?
It doesn't matter.
Why?
Because the US can go after their bank accounts in whatever country they want to. Colin, you've been living overseas. I've lived overseas as well too. Colin, you have to go out and file a FATCA report every single year, stating that, I have a foreign bank account and I have this much money in it. And you have to tell the feds exactly how much money you have overseas. And all banks, all European banks, all global banks that take on any American clients actually have to conform to FATCA. It essentially says that in the name of tax compliance, U.S. citizens living abroad have to dox all of their information through their bank, and the bank also has to provide information back to the feds as well too, so that nobody is actually hiding any money offshore.
And I mean, it's not only the U.S. Also in most European countries, they'll also require, and I imagine in other countries as well, they'll require that you report on any foreign bank accounts that you have. So I live in France. I have to report on bank accounts that I have in the US or in the UK or Germany or wherever else in the world. So it does go both ways. But I think one thing, the blog post obviously is quite grim. And I'm not a legal expert, so I'm not going to say the lawyer's wrong here, there, and everywhere. But the one thing I will say about kind of taxes and regulations is, I think it was a very good point that governments are massive. And I think that we, in crypto in particular, look at them as one big bad boogeyman. And I think the fact is different departments ask for things for different reasons. And they're not necessarily coordinated to say, we've decided you're bad, we're going to strip everything. They do still, in places like the US and most of Western Europe, still do need to have court orders to be able to do a lot of these things. Now, that's not universal. And there is a very valid concern about, a Digital Patriot Act, or even the Patriot Act itself being used and weaponized on these fronts. And that is something that is actually one of the original reasons that I got interested in Bitcoin was looking at systems that were more impervious to this, because I don't think that it's necessarily right that people's livelihoods should be threatened by governments looking in, not even finding stuff wrong, but looking into stuff and freezing bank accounts while they investigate, effectively putting you in financial jail until you're proved innocent. I don't think that that's how the law should work. And I don't, even if that is the way that we're going, I don't think it's something that we should just sleepwalk into. So I'd love to see more thinking about how to build stronger, more resilient things rather than just fancy new Ponzi's. It's fun to play with them. I love, trading JPEGs and all this great stuff. But, I got into this space because I want to see building better tools that are stronger, that build a better financial future, that is more resilient to some of these risks that we do see coming down the pipeline. And I think we can do it. I think there's a lot of very smart people here. But it's really about channeling the funding and channeling the research and resources to those things as well.
Yeah. And look, if you don't think that this, we don't talk about Chainalysis enough and what they're doing, but Chainalysis is based in Virginia, right near the NSA. They're one of the many federal contractors that works with the US government to essentially go out and identify and associate wallets and then provide that to the feds so that they can do their investigations. And these integrations that these address tracking companies are going to be using are just going to becoming more widespread. And so it's naive to think that at some point there's going to be this giant association list and it'll be easy. I mean, all the with Ethereum now, there's no way to get unassociated money anymore. The only this is what I've been questioning going back to Bitcoin as a primary crypto asset recently, just because you can buy mining equipment and mine Bitcoin that has no association with anything at all. No KYC, no anything. But now that we have ETH and now that Tornado Cash has essentially been OFAC'd into death for retail users, there's no way to actually break the chain of Ethereum nowadays and get unidentifiable ETH anymore. It's nearly impossible, and it speaks to really the potentially long-term preferences for Bitcoin, where that if you just go out and buy $1 million worth of mining equipment, you may or may not break even, but that $1 million is going to turn into unidentifiable BTC at some point that has no trace and essentially has just been created on chain and is outside the purview of any sort of Chainalysis company.
We've also, I agree with you. I think something that we've kind of gotten away from as well is when I got into crypto originally, cryptocurrency exchanges existed, but you were always worried that you were going to lose your bank account, your normal bank account. So people had very sophisticated ways to do that. And things like local Bitcoin were still quite popular. Those still exist. You can still get somebody where you can hand them $100 in cash or whatever, and they will send you Ether to whatever address you specify. Those are obviously not without costs and risks and all that great stuff. But I kind of reject that, all is gone if people want to get it without having to go through a massive KYC pipeline for the US government. There are still places where you can get things that are lighter touch in the same way that you would be exposed to rules if you want to swap dollars for euros. In a lot of places in the world, that has very light touch KYC.
Yeah. So we'll see. It's going to be a long process, but we do have the IRS regulations that are coming in 2025, and I'm sure we'll be talking more about it as time goes on. I know that crypto lawyers must be really tearing their hair out over the past week with all of these new documents that have come to light from Treasury, DOJ, IRS, CFTC, SEC, everybody, really, the alphabet soup of agencies really trying to put their foot down and use regulations as a way to stomp up and coming developers from even trying anything, and essentially trying to regulate all crypto activity to centralized exchanges where you can build these, where the surveillance architecture is already in place.
I think we can also spin that in a positive light where, governments want to get the taxes that they feel are due and owed to them. And generally, if we're law-abiding citizens, we should be paying our taxes even if we, hate doing it. But we would expect to have to do that on fiat profits. And if they're looking at making it, on one hand, more onerous for developers, but the other hand, making it easier for people that need to pay those taxes, I don't think that's necessarily universally a bad thing.
But it's not being done in the name of taxes. I mean, we had a functioning tax regime that existed before the inclusion of the Patriot Act and FATCA and all these other,
totally
tax compliance bills. It's not about compliance. It's about control and surveillance at a base level.
I think there is definitely a big part of that, and I think that is something that I absolutely 100% disagree with, and that was something in TradFi that bothered me as well. Of all of the rules that the government could enforce, and finance is one of the rare industries where the private corporations are expected to be the police of their clients, and I don't think that that's something that necessarily we as a society should be in favor of. How would you like it if every time you walked in to get your groceries at the grocery store, they checked your criminal record, they checked, what you had in your car, and would call the police if they suspected you for something? I think most people would be universally against that. But the fact that your bank flags stuff to the government or the regulators because they think you might have done something wrong is a bad thing. I had an interesting discussion over the weekend with somebody that works in a bank locally here. And he said that they do a lot of policing when people send money to cryptocurrency exchanges, not because of the crime aspect, but because they're worried about if somebody loses money on cryptocurrencies, that they'll call somebody at the regulator and they'll turn around and say, well, the bank owes them money back. They wouldn't expect that from a casino. They wouldn't expect that from a stock brokerage, but they expect that from cryptocurrencies. And I think we've created such a bad name for ourselves that and played victims and talked about how bad everybody is. We can have a constructive criticism and say where are the wins and where are we trying to accomplish things. And we need to focus on that positive, mutual, beneficial aspect as well. And I think there are definitely inroads, but how do we focus on selling the positive stories, focus on the wins, focus on the things that aren't just purely speculative? I love them, they're fun too, but above and beyond that, and not just how the government hates us. And we'll get there, and we'll make it more difficult. We'll build things that are stronger, but we need to also focus on why this is beneficial. And I think that if you look at the fabric of the US itself, I mean, a lot of it is about distrust for the government, more so than in most countries around the world. And there still is an open ear, even if it's not necessarily the Gary Gensers of the world.
Yeah. So I wanted to touch on a different stablecoin subject for today. Mountain Protocol launched with USDM.
Yeah.
They are apparently the first regulated and permissionless yield-bearing stablecoin. Think of a rebasing stablecoin that can be wrapped up like Lido's Steth and Wrap Steth, where depending on the amount of yield that comes into the system, it's going to rebase every single day.
It's a very cool idea. The ironic thing, and we were talking about this in our Discord earlier, or in our Slack. I've been in crypto too long. I talk about Discord instead of Slack, about the kind of irony of U.S. citizens not being able to trade U.S. treasuries inside of that. So that is a protocol that they do not let U.S. residents trade.
Yeah. So Mountain Protocol will only allow for non-U.S. people and people that aren't on OFAC or any sort of sanctions list to trade. Interestingly, they did base themselves out of Bermuda. I know the Bermudian government had been trying for a long time to set up a digital asset regime that would be favorable to companies. And this is one of the first major announcements that I've seen come out of here. I think FTX was trying to do some stuff with Bermuda as well too. Binance had shifted some operations there, but it's interesting if they'll become more of a crypto base over the next decade.
I mean, I think we'll see lots of them kind of come and go, but where there is TradFi, I think you will also find niches for crypto-fi.
Mm-hmm. And then our last story today, we have a drama alert. Do we have a drama alert picture overlay, Garrett? I don't think we do. We should get one because this is definitely drama alert. So over the weekend, there was huge drama in the Vesta community as the two of the three co-founders of Vesta, Atom and Midnight Rage, or Midnight, want to rage quit from Vesta. And what they're trying to do is to use their Vesta tokens to allow for like a rage quit, where the treasury is worth about $10 million. They want to essentially burn off their tokens and then take part of the treasury with them and just like leave the community. And so that was the first response. Oh, there was also like a dissolve proposal as well too, just to dissolve the whole thing and not continue working. A little while later, the third co-founder came out and essentially said that, oh, hey, no, these are terrible ideas. And this still looks to be like a hostile takeover. There had been some issues about cultural misalignment between some of the founders, and they are trying to essentially push the token price up. It was at about 14 cents, and now it's heading towards 40 cents as people try to engage in this hostile RFV behavior.
The trials of governance. I think this reminds me, I think there was a discussion in the Nouns DAO as well of something not exactly the same, but people being able to essentially return tokens to get the treasury value out of it.
Mm-hmm.
So this is obviously kind of a different vector for that, but I think where there's lots of money and it's harder to kind of come across, there we go. Yeah. Harder to necessarily come across new revenues, people will start to look to claim what's out there, either to do new things with it or to disassociate themselves from a project they don't want to be in. That's the state of the market. I'm not surprised. And I think we're seeing kind of the overhang of what was, let's all have these valueless governance tokens starting in 2020.
And huge treasuries as well too.
Huge treasury.
Huge treasury.
Also, I think it communicates well with your point from the beginning of the interview, Colin, about DAOs. It's not exactly what we have always we always hope it to be, and it doesn't necessarily something that works smoothly, to say the least. And I think that we're actually we're seeing this process of this whole DAO thing, how it can have all kinds of like different interpretations and what kind of different and specific stuff can basically just happen when you run things in this kind of an organizational manner, with both ups and downs for sure.
Absolutely. I mean, I guess everybody needs to kind of review what they're getting into when they get into any of these crypto things, and where there's a governance component. I don't think people should be surprised when people try to exercise the rights that they paid for by buying these tokens or earning these tokens.
Yeah.
Well said.
Yeah. So last question for you, Colin, is that did you pass the test to become a French influencer?
I'm trying. They released all their guidance. I looked. They don't have the tests open yet. They have. So apparently they're in like their 8th iteration of a global influencer certificate in France. And what they released last week is their financial one. So I definitely will take this, because if nothing else, it seemed like it'd be kind of a funny thing. So I'll take it and write a blog post about what it entails.
Are you even allowed to come on this podcast before taking this test?
Yeah.
It doesn't exist yet, so I have to hope.
Maybe it's only when it's French.
It is a very, very French thing to do. I don't think it's a horrible idea, because if you talk about some of the influencers that have been in the news, you look at BitBoy, you look at some of the other people that are out there, there are a lot of things that a number of these influencers that have done when they have come out to the public light, people wish that they had been disclosed differently at a minimum. So I think it's not a horrible initiative to do it and give people framework for it. It is kind of a funny initiative the way they have done it. It is very French.
It is very French. Well, we'll leave it at that. Colin, thank you so much for being here today. Appreciate the insights.
It was great.
Yeah. And Garrett, DeFi Advisor, great seeing you. And everybody else that tuned in on this wonderful Monday, September 11th, thank you for being here, and we'll see you tomorrow.
Amen.